Happy Sunday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, we look at North America. Wall Street endured a sharp sell-off on Friday as mounting concerns over inflation and trade tariffs rattled investors, leading to the second worst trading day of the year for United States stocks. The S&P 500 sank 2%, marking its steepest drop since March 10th, while the technology-heavy Nasdaq 100 fell 2.7%. The sell-off comes amid growing fears that US President Donald Trump's escalating tariff policies will drive up consumer prices, just as signs of slowing economic growth emerge. The downturn hit the technology sector hardest, with investors shedding positions in major growth stocks. Nvidia Corp, a key driver of the artificial intelligence boom, continued its decline, losing 27% from its January peak and erasing nearly $1 trillion in market value. Other technology giants, including members of the Magnificent Seven, faced sharp losses, while new IPOs such as cloud computing firm CoreWeave Inc. struggled to gain traction in a volatile market. The sell-off was exacerbated by an analyst report from TD Cowen, which revealed that Microsoft Corp is scaling back data center expansion projects in the US and Europe. Adding to concerns, Alibaba Group Holdings Limited co-founder Joe Tsai warned earlier this week that excessive spending on computing infrastructure could create an unsustainable bubble. We discussed this development earlier this week. The market slump was compounded by concerning economic data. The Federal Reserve's preferred inflation gauge showed that price pressures remained stubbornly high, while consumer spending figures came in weaker than expected. The Bureau of Economic Analysis reported that personal spending rose just 0.4% in February, falling short of economists' forecasts of 0.5%. Consumer sentiment, a crucial driver of economic activity, also took a significant hit. The University of Michigan's final March sentiment index dropped to 57, its lowest level in more than 2 years. Long-term inflation expectations surged to 4.1%, the highest reading since 1993, reflecting broad-based concerns across political and demographic groups. The latest downturn follows Trump's announcement of sweeping tariffs in car imports, something that we've discussed over the last few days of updates, reigniting fears of trade wars and economic slowdown. Economists warn that the tariffs could contribute to stagflation, a combination of stagnant growth and persistent inflation, if consumers begin to curb discretionary spending in response to rising costs. Investment banks have already started revising their growth forecasts. Goldman Sachs lowered its first quarter GDP projection by 0.4 percentage points to an annualized rate of 0.6%, while the Atlanta Federal Reserve slashed its growth forecast to show a 2.8% contraction, down from 1.8% earlier this week. As the economic landscape darkens, investors are increasingly shifting away from risk assets and seeking refuge in safe havens like US Treasuries and gold. The yield on the 10-year Treasury note fell to 4.26%, while gold prices surged past $3,110 per ounce. With technology stocks under pressure, consumer sentiment eroding, and economic uncertainty rising, the market faces a challenging path ahead. The coming weeks will be critical in determining whether the recent downturn is a temporary pullback or the beginning of a prolonged correction in equity markets. Next up, European airlines are urging the European Union to scale back its environmental regulations, highlighting the mounting challenges in the aviation sector's transition to sustainable fuels. The chief executives of major airlines, including Lufthansa, Ryanair, and International Airlines Group, IAG, are pushing for a revision to the EU's carbon pricing rules and Sustainable Aviation Fuel (SAF) mandates. Speaking at an Airlines for Europe meeting in Brussels this week, industry leaders argued that the current EU regulations place an excessive financial burden on airlines. The CEO of Lufthansa, for example, emphasized the need to, quote, cut and revise EU regulations quickly, end quote, while Ryanair's Michael O'Leary pointed out that airlines cannot meet the SAF mandates if the fuel supply is insufficient. Under current EU policy, airlines are required to use at least 2% SAF in 2025, with this figure rising to 6% by 2030. SAF, derived from organic materials such as cooking oil and crops, can cut carbon emissions by up to 70% compared to conventional jet fuel. However, it remains significantly more expensive and in short supply. IAG's chief executive warned that unless policies are adjusted, the only feasible solution would be delaying the 2030 SAF target. Airline executives also criticized oil companies for reducing investments in SAF production, while Airbus has scaled back ambitions for hydrogen-powered aircraft. They also advocated for aligning the EU's emissions trading scheme with CORSIA, a global carbon offset system, which critics argue is ineffective. Despite industry concerns, the European Commission has reaffirmed its commitment to the Green Deal and insists that the SAF target remains both, quote, realistic and feasible, end quote. Environmental groups, meanwhile, accuse airlines of exploiting an anti-green trend and failing to embrace meaningful carbon reduction measures. Of course, if prices go up due to these requirements, this will simply be passed on to European customers, who are already facing an inflationary environment and pressure on discretionary household income. Next up, we have one more update to cover, but just quickly, if you're getting some value from today's episode of Market Update, don't forget to hit the like button, and if you'd like to continue to be on top of these developments as they occur, maybe consider subscribing. And finally, for this episode and for this week, let's do a week in review for Japan's economy. This week, Japan's financial minister, Katsunobu Kato, speaking in an interview with UK-based The Financial Times, warned that Japan has yet to fully overcome deflation, despite sustained inflationary pressures and the largest wage hikes in more than 30 years. His remarks highlight concerns that the country's price growth is not yet self-sustaining, even as the Bank of Japan gradually shifts away from decades of ultra-loose monetary policy. Kato acknowledged that consumer prices and wages were rising, but he emphasized the need to assess the broader economic context before declaring victory over deflation. Quote, "It is our judgment at present that Japan has not overcome deflation," end quote, he stated, citing concerns over weak consumer demand and the risk of prices stagnating again. Japan's inflation rate has exceeded the Bank of Japan's 2% target for nearly 3 years, with core consumer prices rising 3% in February. At the same time, the country's largest labor union, Federation, secured an average wage hike of 5.46%, the highest in over 3 decades. Yet in real terms, wage growth remains subdued, and consumer confidence remains fragile. The Bank of Japan has taken measured steps to unwind its long-standing accommodative policies, scrapping negative interest rates in early 2024 and implementing a modest rate hike in January 2025. The key rate now stands at 0.5%, the highest in 17 years, with analysts anticipating further hikes this year. However, policymakers remain cautious, particularly in light of global uncertainties, including US President Donald Trump's trade policies, which could negatively affect Japan's auto industry, something we discussed in depth on Friday. Kato stressed that sustainable inflation depends on robust domestic demand and the ability of small and medium-sized enterprises to pass rising labor costs onto consumers. Without such structural changes, experts warn that Japan could slip back into economic stagnation, with inflation falling below 2% by 2026. Meanwhile, Japan's global ranking in gross domestic product per capita is set to drop from 29th in 2024 to 45th by 2075, according to a new forecast from the Japan Center for Economic Research, JCER. The country's sluggish economic growth and declining population is expected to weigh heavily on its future prosperity. While Japan's real GDP is projected to grow from $3.5 trillion in 2024 to $4.4 trillion in 2075, its ranking will fall from 4th to 11th worldwide. The country's annual GDP growth is expected to average just 0.3% in the early 2070s. In contrast, the US and China are forecasted to maintain their positions as the world's two largest economies, according to this report, with artificial intelligence driving productivity in key industries such as finance and information services. Japan's demographic challenges remain a significant obstacle, something that it shares with China, frankly. Despite a projected net immigration of up to 240,000 people per year, the population is expected to decline to 97 million by 2075, further shrinking the labor force. The report stresses the need for digital innovation, labor reforms, and increased public investment in education to counteract these economic headwinds. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Sunday, have a restful weekend, and I will see you for a new week of updates tomorrow.